week, we've been getting updates on the tariff and trade front, and markets have largely looked through a lot of that volatility and noise. But is something different about the threats on Canada, considering they are a close ally, a close trading partner, and obviously a neighbor?
Yeah, I mean, this is sort of in line with the week in the sense that there is an August 1st deadline on all of these things. But I do think you're seeing a bigger reaction to the Canada one. The other one I would flag as we're seeing a reaction to is Europe. Trump also promised last night around Europe that they would get a letter there today. Either whatever rate he dictates remains to be seen there, but that's also could be another kind of disappointing end to the week, a week that began sort of with hopes of a deal with Europe. Europe, of course, is the biggest trading partner. But as you mentioned at the top, Canada is the big one we're digesting today. And this was another surprise. This was another kind of upward revision from Trump of his Liberation Day 1.0 plans to kind of have this 35% duty on tariffs on Canada. There are a lot of unanswered questions about exactly what this 35% rate means. A big one is whether USMCA goods will continue to be exempt from it. There are indications that USMCA may continue to be exempt from this 35% rate, but there are mixed signals there. The Wall Street Journal has some reporting this morning that it could be exempt, but it's not final. Like everything else with Trump on trade this week, it's all kind of up for negotiation. There's a lot of other unanswered questions on this Canada deal for specific sectors. Oil and fertilizer is another sneaky big issue between the U.S. and Canada. So that how exactly those carve-outs fare if Trump follows through with that remains to be certain. One other quick headline to flag for folks on tariffs today is tariff revenue. We're expecting that we're going to get a formalization later today of June tariff revenue, which would be another record of big tariff revenue coming in from the U.S., well north of $25 billion. And that comes as Trump this week has really shifted. He started the week talking about a mix of deals and letters. It's all about kind of letters and tariff revenue, as he said earlier this week. The question being, well, of course, whether markets believe him, that the big money is going to come in on August 1st, starting on August 1st.
And Ben, that's a question I wanted to ask you, because when you talk to your sources in D.C., are they saying that you should take Trump at his word, or are they viewing it similar to markets, that this is a negotiation tactic?
I think it's a little closer to the market's view of a negotiation. The point I think that maybe is missed by the markets and definitely is taken by a lot of trade experts I speak with is that the taco trade is a real thing. This Trump always chickens out is real because he does back away. The issue is that Trump's pattern is to promise 5 things and then back away from 3 but then 2 remain. So there's still major changes in the trade landscape. I think folks are sort of skeptical that we're going to have a 35% rate on Canada, but it's going to be somewhat higher than it is now. So he's clearly kind of ending somewhere in the middle, which will still be a major change. So I think markets are discounting that these top line rates are what we're going to see, but I do think it's still going to be a raise on August 1st in some form, in some fashion, in kind of coming up to the last minute for certain.
Nvidia CEO Jensen Huang met with President Donald Trump at the White House just days before a planned trip to China for the chip designer's chief executive. For more on the latest from Nvidia, the only member of the $4 trillion market cap club. Let's welcome in now. Got Dan Ives, Wedbush Securities Managing Director, Global Head of Technology Research. Dan, it is good to see you, my friend. I love the look today, Dan. It does look like, you know what it looks like, Dan? It looks like I'm interrupting your tea time. So I'm gonna get through this interview. We're gonna get through it real fast. I feel like you got places to go. Let's start with Nvidia, Dan. Nvidia CEO Jensen Huang, he's on the way to China. We know there, Dan, he can't sell his latest and greatest chips, right? And it's costing his company a lot of money. I'm curious how you think this all plays out. Does he get Trump to reverse course? Does he find a workaround? What do you see ahead?
I mean, he's not going to the White House just to have lemonade with Trump. I mean, the point is, our view is that the restrictions when it comes to China, a lot of that ultimately will, at some extent, be lifted where NVIDIA can sell their chips into China. Remember, I mean, they're not going to just give $8 billion a quarter to Huawei on a silver platter. And it's all part of this negotiation that you see. But there's only one chip in the world fueling the AI revolution, and it's led by the godfather of AI, Jensen NVIDIA.
If he can't sell his latest and greatest in China, Dan, how does he make that up? Could demand from the sovereigns, the Saudis, the UAE, could that make it up?
Look, that can make it up. And I still think Street's underestimating growth by 20, 30% in the next few years. But you do not want to give China just away to Huawei. I mean, where NVIDIA can't touch it. And they know, and Jensen knows, That continues to be the biggest market incrementally that they're going after besides the US. And it's all part of this negotiation. You cannot just hand that business to Huawei. And that's why, look, it's all part of this high stakes negotiation. But there's only one chip in the world that's fueling it. And Trump knows a big poker chip that he has in negotiations is Nvidia.
I'm sure there are some viewers, Dan, this week when they saw Nvidia hit that milestone, right? They might have thought, hey, I missed my chance, I missed my opportunity. I know you feel differently. What are the catalysts that keep this one, in your opinion, moving higher?
I think 5 trillion and beyond are next, because it's my view, we're in a golden age for tech. It's led by Nvidia, but it's speaking to the AI revolution. I mean, behind the velvet ropes, they're going to let Microsoft into the $4 trillion market cap club as well. When it comes to Nvidia, this is still just the beginning of a 3-year tech bull market, and it's being led by Jensen.
Let's switch gears to another name I know you like, Dan, and that would be Tesla. You like the name. You don't seem happy with Elon Musk and how he's spending his time. He's right back into politics, right? Full speed ahead. He's going to create this American political party, this new political party. You laid out changes you want from the Tesla board, Dan. You say new pay package for Musk to 25% voting control, guardrails for the amount of time Musk spends at Tesla, and oversight in political endeavors. Does any of that actually happen, Dan? What odds would you give it?
Yeah, and obviously Musk didn't like, what we laid out. I believe the odds of that happening are ultimately just some combination more than 50% in terms of that. And especially when it comes to 25% voting right, what I view as an XAI merger, to me, that is ultimately sort of the next stage to where we see this all heading.
I have to ask you, Dan, only because we're showing the post there. When you lay this out, Elon Musk says, shut up, Dan. So the owner of X, on X, guy's worth $400 billion. He tells you to shut up. You saw that, Dan? What did you think and feel when you saw it?
Look, I mean, I knew Elon and knowing, for 20 years and him and following Tesla and being such a big support, he wasn't going to like it. But again, friends could disagree, right? And so hopefully, over the coming months, we're able to work out our differences. But as one of the biggest supporters of Tesla, we needed to do that. Given our view, that's what the board needs to do to ultimately move this forward. Tesla's going into its biggest stage of growth ever in autonomous and robotics. Musk needs Tesla, and ultimately the biggest asset continues to be Elon.
So you had your criticism there, Dan. It's important to note you remain bullish. You tell your clients are at Wedbush. They ask you what to do with them. You say, listen, this one's an outperform. It's still a buy. What would you need to see, Dan? What would have to happen for you to rethink that rating?
Look, I mean, to me, it just continues to sort of be, this is going to be one of the biggest winners in AI along with Nvidia. So for me to get bearish, I don't see it relative to everything we see in front of us when it comes to autonomous.
Finally, Dan, another ticker. I got to get this one in. Let's talk Apple. Another name you like, right? The team at Lightshed made some news this week with a provocative report. I know you saw this, where they were asking, is it time for a new CEO at Apple? You know that company well. You know the CEO well. What's your response to that question?
Cook continues to be the Hall of Fame CEO. He will lead Apple, I believe, at least the next 5 years. That said, AI revolution can pass Apple by. I believe the time's come for them to make an acquisition in terms of Perplexity. And I think that's different. It's Cook reading the room on this next chapter. Because look, you miss AI, that would taint a big part of his legacy if you miss the AI revolution.
That would be a hard shift to do an acquisition like that, Dan. I mean, Apple does do, acquisitions, but traditionally they stay small. I think the biggest one they ever did was Beats for $3 billion. What kind of odds would you give that they would make a move? Perplexity, I think, valued at around $14 billion, I believe.
I believe they don't have a choice. They have to do a deal. I get the DNA of Cupertino. We could build it better than them. But it comes down to, it's like a baseball player in a slump. You got to change your bat, right? Mantle, Cobb, Garrett. You go back, Babe. They change their bat. Cook, it's time to change. Need to be perplexity, in my opinion.
Finally, Palantir, messy of AI, as you put it, Dan. You raised your target. You go to 160. You're doing your checks, and obviously you like what you see. What are you seeing? What are you hearing?
The AI revolution is being led by Nvidia and Microsoft, but Palantir, they're going to be one of the core players. I think it's $1 trillion company in the next 2 to 3 years. And look, the haters will hate, but it's just the beginning of the use cases playing out on enterprise, on government. That's being led by CARP, and that's why there's only one Messi of AI, and it's PLTR.
What do you say to the skeptics, Dan, the bears, who will say, listen, and they've been on this show, and I've asked them, they'll say, listen, I like the tech, they'll tell me. I like the fundamentals. I don't like the valuation. It's an irrational valuation is how they'll put it. They'll say, at these levels, the risk reward does not look attractive. What's your response?
The bears are in hibernation mode, and in their spreadsheets, they can see AI. And if you focus just on valuation, you missed every transformational growth stock the last 20 years. And Palantir, they hated 15, despised it at 50, yelling at 100. It's going to continue. Again, it's like right now, this is being what I view as one of the best AI plays in the world.
I know you tell your clients to say this one on the path, you argue, to become the next Oracle.
It's the next Oracle, the $1 trillion path. They're in a left lane, a Ferrari going 100 miles an hour. A lot of the competition's in a minivan going 45 miles an hour right lane.
Dan, always good to see you. Always good to have you on the show. Thank you, sir.
Thank you.
President Trump is pushing through with his tariff agenda, unveiling a new batch of letters to country leaders outlining tariffs on goods imported from their countries beginning in August. For more, let's welcome in Yahoo Finance's senior columnist, Rick Newman, for this week's rendition of Trump-onomics. Rick.
Hey, Josh. Well, this week we had the July 9 deadline for something like 90 countries to make 90 trade deals with the United States. Of course, hardly any have done that. So what happened? Well, one thing happened is we got a new deadline, which is August 1st, and Trump has put out some numbers that these countries will face on tariffs on their imports if they, once again, don't come up with a deal. But we also got some surprises that markets were not expecting. We got a 50% tariff threatened on Brazilian imports, and that's for political reasons, not for any economic reasons relating to Bolsonaro, the former president down there who's facing prosecution charges. We got a new threatened 50% tariff on copper, maybe a 200% tariff on pharmaceuticals. And then the tariff on some Canadian imports, which used to be 25%, Trump says that's now going up to 35%. Almost nobody can keep track of all this. And I think what markets need to learn is this idea that there's going to come one of these deadlines and we're finally going to have some clarity on Trump's overall tariff plan. I think we should just forget about that. I don't think there's ever going to be clarity, because what we're learning is that Trump now thinks he can use tariffs to do just about anything. It's not even related to economics anymore. He can go after enemies. He can reward friends. And he can do this on his own without any cabinet secretary having to approve it, without Congress. So we're going to get to this next deadline on August 1st. Maybe some new tariffs actually will go into effect. But I think Trump is going to just keep this confusion going in markets because he's figured out it's a powerful tool for him. So markets just have to get used to this.
I wanted to, Rick, we've been talking, the two of us, about investors are also trying to figure out where all this falls on the value chain. And so I thought it was interesting. You see this Bloomberg headline that Japan's car makers slashing export prices to the U.S. to offset the tariff hit. And I just wonder if maybe what markets are thinking is that, you know what, however this shakes out, it's going to be in some way dispersed and not as material and meaningful. And maybe that's why all week, as you said, even though these headlines, to your point, Rick, I had trouble keeping up with the headlines, right? But the market just shrugged.
Well, I did it or didn't it? I mean, we had a nice string of new record highs in the stock market, but that stopped, and we didn't have a huge sell-off when we got these tariff surprises, but markets went sideways. I like to keep reminding people that, okay, we have, the U.S. stock market is up. What is it, up 6% or something like that this year? The U.S. stock market is seriously underperforming foreign stock markets, and the Sell America trade is not over. So we're chugging along here, but we're lagging behind everybody else to some extent. And Josh, I think we are in the process of everybody figuring out where the tariff pain is actually going to land. Trump has spread this. So Trump is cutting this in many ways. He's got product-specific tariffs. He's got country-specific tariffs, and then he's got, for example, the Canadian tariffs. Only some Canadian imports are subject to those, and then every month it's another category of products. So this just takes its time to work through. First of all, to work through supply chains, then to show up in corporate costs. And then for the importing companies to figure out how much of those costs they're going to be able to pass along, and then for consumers to see the changes, and then for that to show up in the actual data. So, and we just had, the Economist, I thought, got it right, who was just on right before, saying it's going to take a few months for all these things to work their way through. We're going to see something by the end of the year, and a year from now we're going to have a better picture. And it's probably not going to be a pretty picture, but Trump doesn't care right now. Trump is, he's not chickening out. The average tariff rate is continuing to go higher. It was about 15% 2 weeks ago. Now it's about 18%. And Trump is going to keep some of those tariffs on, and there are going to be some new ones. So this is all here to stay, including the chaos.
No chickening out. Taco trade be damned. Thank you, Rick. Appreciate it.
See you, Josh.
To close out a whirlwind week of tariff announcements, President Trump threatened a 35% tariff on Canadian goods late Thursday. He also said in an NBC interview he plans to impose blanket tariffs on most U.S. trade partners, while also dismissing any negative impact the levies could have on inflation. Here to discuss the latest is Lou Bassanese, founder of thebigskinny.com, and Washington correspondent Ben Werschel. So Ben, let's start with you here. What's the significance of Trump's threat to Canada?
Pretty significant threat, partly because of the surprise nature of it. Canada was seen as on a different timeline. It wasn't included in Liberation Day 1.0. So what we're seeing is this kind of surprise with this 35% rate on Canada. We do have some new details this morning about exactly what this 35% rate means, which may be a little bit of a bomb to markets here, which is that a White House official tells me that this is a raise from 25% to 35% on certain goods. At least it's expected to be. Other carve-outs that have been negotiated over recent months are expected to continue. I stress the word expected. The big ones there are USMCA compliant goods. That is estimated to be about 40% of goods of imports from Canada. Those would continue to see lower rates. Many of those have zero tariffs based on the 2020 agreement. Those will be up for negotiation next year. The other big one is oil and fertilizer. Potassium-based potash. These have been big flashpoints, partly because of how crucial they are to kind of the functioning of the U.S. economy. They see a 10% rate now, and again, the expectation is that rate would continue. The White House official stresses to me, nothing is final here. Everything's up for negotiation with Trump, and this all leads to an August 1st deadline that we'll see back and forth on here. But the expectation right now is that those carve-outs will continue, even as everything else goes to 35%.
Ben, I don't know how you do it because these back and forth trade developments, they're confusing to me. But real quickly here, what TBD trade deal do you think investors are most focused on right now, at least when it comes to getting a little bit more clarity?
Yeah, I mean, the big economic shoe we've been waiting for to drop, we've been kind of waiting all week, is outside of this is the European Union. This kind of was a week we came in expecting there might be some sort of deal there. There's been parameters floated that would be really market friendly of a 10% rate with certain carve-outs for certain industries. That would be a major deal if that goes through. We haven't seen it yet. And what Trump has promised, his latest promise is that today we're going to get a letter to Canada, or to the European Union, excuse me. So that would be coming today with Trump dictating rates, and would be a kind of negative end to this week that had optimism on the European Union front, depending on how he does. Again, everything is leading to this August 1st deadline. The response from Europe all week, as I should mention from Canada in response to this, is we're going to keep talking. We're looking to August 1st now. So nothing is set right now, but the European Union is definitely the other big thing we're watching today.
Joining us now is Stephanie Aliaga, global market strategist at JP Morgan Asset Management. That firm has $4 trillion in assets under management. Welcome, Stephanie, to the show.
Thanks for having me.
So let's start with Trump and tariffs and those headlines, Stephanie. It seems like the market continues to just shrug that off, because I'm looking at the popular averages. They're all green right now. In part, Stephanie, is that because investors think, okay, well, the deadline, it's weeks out, it's August 1st. I can kind of put that to the side for now. Is that what's going on?
There's two things. I think, the question is, what do tariffs mean for the economy? What do tariffs mean for the markets? And right now, they're telling you different stories. We think for the economy, there's still a pretty significant drag underway when it comes to tariff. We have this all-star athlete, the U.S. economy, and we've just put like a 50-pound backpack beneath it, and we're not going to expect it to run as fast as it has historically or the last couple of years. So we do see more slowdown to come. That has implications for margins and for earnings this year. But when the company is leading earnings overall, and markets are so narrow in nature and are really more aligned to the strength and the secular theme when it comes to AI, that's where tariffs become less of an issue, particularly given that we've seen there is less of a desire to really clamp down on semis and other really tech-sensitive imports from the administration.
That slowdown, Stephanie, you see for the economy, is that baked in terms of corporate earnings expectations?
We don't think so, and there's likely more to come. I mean, some of that is, but it's hard for analysts right now to assume what is the effective tariff rate that we're going to be looking at this year, and also what are the different carve-outs that we see for certain countries that maybe companies can just reroute their imports from versus ones that maybe they really can't. I mean, these sectoral tariffs are actually the bigger risk for margins, we think. So more of that is likely to come. I will say the hard data so far has shown a lot of resilience. This is an all-star athlete, right? But there is still, I think, a lot of weight that is yet to be appreciated by the market.
Let me ask you about another thing we were just talking about at the top of the show, which is Nvidia. I'm just curious to get your thoughts on sort of just the broader mega AI trade and theme, Stephanie, and how excited still you are about that.
Yeah, there's three key things going for the AI theme at large right now is that we've had significant advances in the capability of these models, another one this week. Also, the capability from enterprises now that they're investing in their own niche use cases and agents. Beyond that, we also have the cost curve, right? Costs are coming down, hardware is getting more efficient, and then adoption is really picking up. And so what does this mean? Well, as adoption is widening, you have more potentially buyers for AI services and AI infrastructure. That gets to that timeline to profitability. Maybe it's quite quicker for these, far quicker for these companies relative to prior tech waves, and we've definitely seen that. And beyond that, I think it also suggests that the beneficiaries of AI are also broadening out. So we see the narrowness in the public equity market, but we have to think about what are the other players in this space, maybe on the receiving end of all of this capital spending from the hyperscalers. Maybe they're in private markets. You know, the AI coding boom went from generating $300 billion in revenue last year to now 1.6 trillion, largely led by a lot of private companies. So what are some of those opportunities? So for us, it all comes down to you need diversification, not just our risk management, but also if you're trying to really take advantage of the emerging winners here in the AI.
Q2 earnings season on deck, right? Big banks are coming first. What are you listing for there? When you hear CEOs and CFOs talking, do you want commentary? Is it the economy? Is it tariffs? Is it consumers?
One thing that really surprised us to the upside last quarter was how companies were really looking at their war chest. You know, what can we do to either manage headcount, reduce costs, move supply chains to protect against tariffs? And then also, who's the consumer that we're selling to, and what is the price sensitivity that we're getting from them? And so I think from this quarter, what we're looking at, and what we've heard from the airline so far, very early, but some signs of a bit of a rebound in that consumer in demand, particularly for discretionary spending. That's a good sign. We think also just the ability to kind of manage some of these tariffs, maybe you're passing those along to consumers given the continued resilience. That will be good news. And then overall, I think if companies now feel that they have the confidence to make those capital investments, to increase headcount where needed, I mean, that would be something that really makes us feel quite comfortable about the underlying health in corporate earnings. But right now, we're looking for a bit more of a mixed bag in messaging.
So against that backdrop and that environment, Stephanie, broad strokes, how are you advising clients to be positioned right now?
We think diversification is really, really key right now because markets are extremely concentrated. If you were, for instance, to allocate some money to a quality ETF, a value ETF to help diversify that growth exposure, you might be surprised to find that many of those ETFs or indices contain something like 15 to 20% of a weighting in the 3 mega cap tech companies. So you need to think surgically about diversification in this market because we don't want all of our eggs in one basket. One thing that DeepSeek did for a lot of us earlier this year was remind us, look, surprises can come in this AI race from where we least expect it, right? At the least expected time. So you want to make sure that you're in a boat that is sturdy, that can really take you through whatever may come. Because there's still a lot of uncertainty out there.
Stephanie, great to have you on the show as always. Thank you.
Thank you.
Barbara, I want to start with you on what we're seeing in the equity markets, which is not much in terms of reaction to all of this. We've been talking with Ben a lot about this too, that maybe there's just not really taking seriously that, the market does not seem to be pricing in, for example, that a 50% tariff is really going to be imposed on Brazil, right?
Right. Yeah, Julie, I think you're absolutely right. Now, the market is discounting based on his past behavior leading up to this. After we had the April 2nd announcements when the market sold off dramatically, thinking this really is bad, and it would have been very bad if he hadn't backed off, and we had the 90-day pause. So now that he's coming back, it is very widely seen that it's a negotiating tactic, that he is sending these letters out and telling people this is what will happen if you don't come to the table. And so this 50% moves, or the 20 to 40% range in general, is probably not going to stick, is what the market's assuming. Now, if we're wrong, it's going to be a nasty shock. But right now, I think that's clearly what the market is expecting.
German automakers may be feeling the pressure from President Trump's auto tariffs. For more, we're bringing in now Yahoo Finance senior autos reporter, Praz Sumranian. Praz.
Yeah, so luxury brands like Mercedes and Porsche getting squeezed here, right, by the 25% sector tariffs on their cars. So we saw some results coming in for Q2. Mercedes global sales down 9%, but U.S. sales down 12%. Porsche sales also down globally, but they're higher in the U.S., but there's a little caveat. They're basically saying that they have to rely upon pre-tariff inventory that they already brought in that help boost sales, as well as the fact that they ate some of the tariff costs with protecting pricing. So that's kind of a problem. And I spoke to Mercedes too. I asked them about what are you guys going to do for going the rest of the year. They said, quote, "We recognize the importance of consistency and transparency for our customers, committed to maintaining current model year 2025 pricing until further notice," meaning they're going to freeze prices for now. And for you, if you order a new car for a 2025 model new car, we continue to monitor the situation closely, are evaluating all options. We'll adjust to changing market conditions and the competitive landscape. So what they're saying is that they can't do this forever, right? They can't price protect forever, and it seems like model year 2026, we'll see some changes from pricing point of view. Look, they need a deal. They need a deal like the UK has with the US right now. 10% is what they have. That'd be great compared to 25, but it's not perfect either.
Who's in the worst spot, Praz? Porsche or Mercedes?
So with Mercedes, at least, they have a factory in Tuscaloosa, Alabama, where they make a lot of their SUVs and a lot of their EVs. Porsche makes everything in Germany, and I think another plant in Slovenia. That's it. They're known for German engineering and kind of European handling and things like that. So to make cars in, let's say, Indiana, it isn't really on brand. So they're kind of in a tight spot there. BMW, which hasn't released their full data yet, big plant in South Carolina where they build all their SUVs, where they actually ship them out to other parts of the world.
All right, Praz, thank you, buddy. Appreciate it.